What if I told you that a small financial instrument called credit default swap or CDS nearly crashed the global economy in 2008, and that some investors still use it to make millions? Sound interesting, right? Well, today I'm going to break it down for you in the simplest way possible. Hey everyone, welcome back to the Financial Savvy, where we simplify complex financial topics so that you can make smarter investment decisions. If you love learning about finance and investing, don't forget to hit the like button, subscribe, and turn on notifications so that you never miss an update. So let's dive into today's topic, which is credit default swap or CDS. So here you can see on my screen as well, I'm presenting you a deck that I prepared for the CDS to explain you what exactly the CDS is. So let's start with the basics. What is the meaning of CDS? So a CDS is like an insurance for loan or bond fails to pay the debt defaults. So basically what exactly it is, I here explained the definition in 3 pointers. It's like an insurance. If a company or government fails to repay the debt, the CDS seller compensates the CDS buyer, used by the investor to hedge risk or speculate. So what exactly here I'm trying to explain you. So basically a CDS is a financial contract that works just like insurance. That's why in the first pointer I mentioned it is like insurance, right? But insurance for what? Insurance for loans and bonds. In you can say in the first line only, you can see here I even mentioned for loan and bonds, right? So it's like an insurance for loans and bonds. Basically it protects investor from the risk that a company or a government might not pay back their debt. So in second pointers I explained this, a company or government, in case if they will not pay back their debt, so for that matter CDS provides sort of an insurance, right? So, and this is used by the investor also for hedging risk or speculation, even for the purpose of speculation also. A lot of traders use CDS. So in the third point I'm trying to explain, if the borrower defaults, right, the CDS seller, like a bank, compensates the CDS buyer, the investor. So think of it this way: you own a valuable asset, right, and you buy insurance to protect it, right? So if something bad happens, you get compensated, right? So that's exactly what a CDS does for the financial markets. So I'll try to explain in a simple example in the next slide. So I'll try to explain now. Here you can see how does a CDS work. So now let me give an example that makes this super easy to understand. Imagine you lend 1 lakh rupees to a friend, right? But you are little worried. What if they don't pay you back, right? So you go to an insurance company, let's say to a bank, right? And you'll say that, hey, if my friend doesn't repay me, you will cover my loan, right? Here in the second point I'm trying to explain this. If they want to repay, so you are trying to buy a CDS, right? So you go to an insurance company, a bank, and ask them that if your friend doesn't pay, then they will cover the loss. So the insurance company agrees, the bank agrees, but they charge you a small monthly fees for taking on that risk, right? Small monthly fees to the insurer. You are the insurer. You are going to the bank to buy that insurance in case if your friend doesn't pay you in future, right? So that's the way. And for that matter, to compensate you in the case of defaults, the insurance company, the bank, would charge you a monthly fees for taking that risk. Now two things can happen: your friends repay the loan, right, and you only lose the small fees you paid for the protection, right? You paid for the protection at the initial stage only to the bank, so that bank would cover you in case of default. So that's a piece that you will lose in case if your friend will repay the loan. Second thing can happen: your friend fails to repay. The insurance company, now in this case the insurance company, the bank, the CDS seller, the credit default swap seller, compensate you for the loss. So that's exactly how credit default swap work in the financial world, but just on much a bigger scale. So like this way I try to explain. In case of default, the insurer pays, the bank pays you the 1 lakh, right? So this is the conclusion: the risk of loss is transferred to the insurer. This is the key objective of the CDS. The risk of loss is transferred to the insurer against a simple fees, against a monthly fees. It can be monthly, it can be quarterly, it can be annually, it depends, right? Case to case. But against a monthly fees, you are just transferring your risk to another insurance company. Here insurance company can be different sort of organization. Here we took an example of bank. You are just transferring the default risk to the bank against a monthly fees. So that's how the CDS works actually, right? So that's the example I now explained you. Now in the example I explained you that you were one of the participant, bank and your friend. Now I'll try to explain you in this slide that who are actually the participants in the CDS. Now we understand how CDS work, right? I explained you the example. Now let's have a look at who's involved in these contracts. Although I explained that too in that example only, but now I'll try to explain you and clarify you what exactly we are saying to those participant in the CDS contract. So first is CDS buyer. CDS buyer is the investor lender who pays for the protection against a bond default. CDS buyer wants protection against default, right? You, in the example, you were the CDS buyer because you were paying for the protection against a default of your friend, right? So you were the buyer. CDS seller. CDS seller is can be a bank or some other institution. So basically, it's a institution who takes on the risk and promises to pay if a default happens, right? And the example as well, I explained you that yeah, you were transferring the default risk to the bank. So in that example, bank was the CDS seller who was taking on the risk in case of a default happens, right? So for that matter, the bank collects the fees as well, right? What we learned in the example too. And the reference entity, the third participant in the CDS contract is the reference entity. It can be a company, government, actually who is issuing the data actually. So in the example, my friend or your friend was issuing the debt to you or to me, right? So he was the reference entity in the example. So the borrower who might default, triggering the CDS default or CDS payout actually, right? So here the reference entity to whom I actually said that yeah, in the example we were lent the money, we were trying to lend the money to my friend actually. So the borrower whose default triggers CDS payout. So the reference entity means the borrower who might default. So in the example, I explained that yeah, I or maybe you was a lender, right? And who provided the money, who you lent the money to your friend, and now you have a fear that maybe your friend might default. So your friend in the example was the reference entity, the borrower who might default, who made triggering the CDS payout. So these are the players basically, right? And these are the players who all are makes the CDS market, right? So these are the participant I explained. Now you know who all are the participant in the CDS contract basically in the market. Now we'll try to understand why do investor use CDS. Although it's very much self-explanatory now to you because I already told you in the previous slide what exactly the meaning of CDS. It's a sort of insurance. So for that purpose only we use CDS so that we can cover ourselves up in case of a default, right? If we are lending some money to the reference entity or like a company or maybe somebody else, maybe government, and in case if they might default in the future, so in that case the CDS would cover us. The CDS would help us to recover those losses, right? So for that purpose only the investor use CDS. But for apart from that, CDS also you use for other purposes as well. Here in this slide I'm trying to explain that. So first is the risk management, right? The risk management means the hedging that I already told you. Investor use CDS to protect their bond investment or against loans investment, right? Because like if you are lending something to somebody else, so you are trying to protect yourself from losses in case the other person will default in future. The second use is the speculation. Investor actually some of the times use CDS for speculation as well. Speculation means they are trying to bet on defaults. Trader use CDS to profit if they believe a company who takes on the loan actually might go bankrupt, right? So that's why they speculator use CDS in that case as well, right? They take on they actually take bet on the defaults of the reference entity. Here the reference entity means who actually taking up the loan, right? The borrower who might go bankrupt. So against that they actually take the bet. So that's why they use CDS for the purpose of speculation as well, because in case they will take a bet that yeah, the company, the borrower will make a default in the future, the price of the CDS actually shoots up and they can make the profit, because earlier they bought the CDS at very low prices, and when the probability of the default of the borrower will go up in the future, then that will trigger the prices of the CDS it will increase the prices of the CDS, make the prices of the CDS very expensive, and in that way they can make the profit. So in a way they are just speculating, right? I'll try to explain the speculation part in further slides as well. So I can, in this slide, you can just think that yeah, CDS, apart from the risk management hedging, they traders also use CDS for the purpose of speculation. Arbitrage is also one of the uh, sort of use for CDS, the reason of usage of the CDS, because some investors make money by exploiting the price mismatches in the CDS contract. So arbitrage is all about the making money using the price mismatches, right? So that's why in case if there is a price mismatch in the market of CDS, then they can make the profit, right? So although the primary use of the CDS was designed as a risk management tool, but now many people use it as a way to make big bets, like I explained, the spec for the purpose of speculation in the financial market, and some of the times for arbitrage as well. So now I'll tell you I'll try to explain you some of the case studies, how actually CDS are used in those scenarios and what happened. So all right, now let's talk about some biggest CDS disaster in history. First of the biggest disaster in the history is the 2008 financial crisis. So before 2008, banks and investor bought CDS to hedge mortgage-backed securities, right? So before 2008, banks were giving out risky home loans, actually subprime home loans. So to protect against defaults, they use CDS actually to insure these bad loans. So at that time, AIG, a massive insurance company, sold billions of dollars in CDS contract, right? And they were collecting the fees, but not keeping the enough reserves to cover potential losses. I explained to you that, yeah, or if you are selling the CDS contract, then you will get some sort of a fees, right? Because you are trying to provide the cover in case of a potential losses in future. So that's the same happened in the case of AIG as well in 2008 financial crisis. They collect the fees, but they don't have the enough reserves at that time to cover the potential losses in case if all the borrowers will make the default. And what happened? Then boom, Lehman Brothers collapsed. Mortgage defaults skyrocketed actually at that time, and AIG even couldn't pay up. And that time, the US government had to bail out AIG with around 182 billion US dollar to prevent the global financial collapse. So that's the whole scenario actually happened at that time because of the CDS only, because AIG sold a lot of CDS contract, right? In a simple sense, they sold a lot of insurance by collecting a small fees, but they don't have, at that time, they were not having the enough financial reserve to cover the losses, right? And because of that reason, everything collapsed. A systemic risk happened in the financial market. So that's why this is a classic example of how unchecked use of CDS can create financial disaster. Because at that time, banks were just trying to provide the loans to any Tom, Dick, and Harry, yeah, and that was a very risky home loans, and there was a high potential and high probability of the default. And AIG just solved the CDS contract without any second thought, and at that time, all the borrowers default simultaneously, right? And AIG didn't have the enough reserves to pay back to the CDS buyer, to the banks who bought the CDS contract from AIG. So in that way, everything collapsed. So that's why we should have a check on the use of CDS. We can't overuse anything without having a check on the risk, without having a check on the probability of the default, right? So that's the way, and that everything collapsed at that time, and CDS played a very major role. So that was all about 2008 crisis, right? Lehman Brothers defaulted, AIG couldn't pay, lending government bailout. I explained $182 billion. Now I'll explain you another example, right? A Greek debt crisis. It's a very popular example actually. So take another look. So how CDS played a role in Greece debt crisis actually. So Greece was borrowing a lot of money at that time, right? But investor feared that it wouldn't be able to pay back its debt. The Greece government wouldn't be able to pay back the debt. So investors started buying CDS on Greek bonds as insurance against default, like the way I explained, right? If you are lending money to Greece, let's for an example, I'm lending money to Greece, but I have a fear that maybe in future the Greece government would make default. So for that matter, for covering up the future losses, I'll go to the bank and take insurance, and insurance means I'll buy the CDS contract, right? That's the same way investors started buying CDS contract on Greek bonds, right? As more people bought CDS, the prices soared actually, because now the demand of the CDS at that time was going up. That's why the prices of the CDS soared high, and it's showing a rising fear of the Greek default actually, because now everything is just at that time was running to the bank and buying the CDS contract against the Greek bonds. Then at that time it showed that Greek I mean there was a huge probability of default in the Greek bonds, because everybody was running to buy the CDS, right? And it also raised the prices of the CDS as well. So that's why it completely showed that there is a fear of Greek default. And guess what? In 2012, Greece partially defaulted actually, and that's why it triggering the CDS payout. And when it triggered the CDS payout, it shake the global market, because they defaulted at that time, and all the CDS sellers weren't able to pay in full to all the CDS buyers. So that's the way actually. Some of the times, if we don't use CDS in a proper way, in a mindful way, then it would trigger a major systemic risk in the financial market. Systemic risk for you in a very simple way is the snowball impact, right? It will create a snowball impact, a domino effect in the financial markets. Everything actually will collapse in case if it is unchecked. So that was happened in Greek debt crisis because of the CDS. Now, third case study, I'll explain you about the hedge funds, because hedge fund also use CDS a lot of times, and they usually use CDS for the purpose of speculation, right? Not for the purpose of investing, or maybe taking for the purpose of taking insurance again, lending money to the borrowers. The whole purpose of the hedging funds is to trade CDS to make profit out of it. So in short, speculation. So they usually shorting debt, right, using CDS, right? So some hedge fund buy CDS. Why they are buying CDS on company? Because they are believing that they believe the company will go bankrupt. So in case, let's say if there is a hedge fund and there is a hedge fund, and that hedge fund is buying CDS of Bank A, right? Why they are buying CDS of Bank A? Because they believe that Bank A will go bankrupt. Although hedge fund didn't lend any sort of money to that Bank A, they didn't lend any money to Bank A, but still they are buying CDS, because CDS is something which actually trades like these stocks, trades like shares in the secondary market too. So that's why they just buy the CDS of Bank A, and they believe that Bank A will go bankrupt, and if the company struggles, CDS prices actually rises, because here hedge fund actually speculating that Bank A will default in near future, right? So, and in case if the Bank A will struggle actually in near future, then it's but obvious that CDS prices will rise. Why CDS prices will rise? Because the issuer of the CDS, let's say if there is a issuer A, issuer Y, they will issue CDS. They will issue CDS. They will issue insurance against high prices, right? Against high prices. That's why if the probability of default of Bank A will go up, then the prices of the CDS will also go up, because now for covering up the losses of Bank A, whose probability is like 80%, issuer Y will charge more fees, more fees. Obviously, it's very but obvious. They will charge more fees to provide the cover, to provide the insurance, because the probability is very high against which they are issuing the CDS, right? Against which the issuer is issuing the CDS, issuing the insurance contract, because they know that there is 80% probability, 90% probability that they have to pay money against the losses of Bank A, because Bank A 80% chances, 90% chances will default. That's why the CDS prices will rise, right? And when the CDS prices will rise, the hedge funds will sell the contract for a huge profit, because earlier they speculate that Bank A will go bankrupt. That's why at very low prices they buy the CDS contract, and when the probability will rise, actually CDS prices will rise, and the hedge fund will sell all the CDSs at very good prices. So this actually even happened during 2020 pandemic as well. Hedge funds actually used CDS to profit from struggling companies, because they already shortlisted that these 10 companies say will default in near future, and right now we can buy the CDS contract of these 10 companies, because as of now, as of now, the CDS, CDS against these 10 companies are trading at very less prices, but they predicted that these 10 companies will default in near future, and when they will default, actually the probability of default will actually increases, let's say maybe after 1 year, maybe after 6 months, then the CDS prices will shoot, and the hedge fund will sell all the CDS contract in the secondary market and make the profit. So that's the way actually hedge fund use CDS, for the purpose of trading, not for the purpose of risk management hedging, right? So that's the way I explained you the use of CDS as for the purpose of trading by the hedge funds. Now I want to explain you the benefits and risk of CDS, the credit default swap. All right, so now that we understand how CDS, credit default swaps work, let's discuss something about which is, I believe, very super important, the benefits and risk. Because while CDS can be a powerful financial tool, no doubt, but they also come with some serious dangers actually. So we'll start with the benefits. So one of the biggest reason investor use CDS is to protect themselves from credit risk. Now we know it very well now, based on the definition as well and the case studies we actually learned so far. So if a company or a government default on its debt, the CDS contract ensures the investor don't lose all their money. So example, I'll try to give an example. Imagine a big pension fund holds billions of dollars, right? Billions of dollars in corporate bonds. Right? Now they buy CDS. They buy CDS to protect against the risk of those companies failing actually, because they already hold a millions of corporate bonds. That's why, to cover the potential losses against these corporate bonds, they buy CDS from maybe banks or financial institutions, right? Some financial institutions, they buy CDS. So if one defaults, the CDS pay out, minimizing the losses actually, right? So in case if they hold millions of corporate bonds, maybe across 100 companies, and one company default, then bank or financial institution who's actually sold the CDS contract to us will compensate against losses. So they will compensate against losses, right? So this is why CDS is often called insurance for bonds or loans, right? Second is, it enhances the market liquidity. How? CDS actually, and that's what I explained in the second point, it provides market liquidity. CDS allows banks, investor to trade risk more easily actually, right? And it making the bond market more liquid and flexible. So I'll give an example. So if an investor, right, no longer wants to hold a risky bond but can't sell it easily, so what he can do, they can simply buy a CDS instead, right? Because they can't hold the risky bond, but at that time he even can't sell it, so they can simply buy a CDS, right? And this makes risk management more efficient actually, right? So a liquid market means better pricing and more opportunities for the investor here. What exactly I'm trying to explain you here in this point, how it exactly enhances the market liquidity, means better pricing and more opportunities for investor, because that bond is quite risky. Investor knows that. That's why he's not able to sell it in the market. So what he can do, he can buy the CDS, right? So that in case in future that risky bond will default, so that he can be compensated with the help of the CDS. Bank will compensate the investor, right? So that's the meaning of enhances market liquidity. It means better pricing, more opportunities for the investors. Third is, can be used to hedge bond, right? Hedge bond investments, like the way I explained, can be used for speculation. Some investor use actually CDS not just for the purpose of protection, but to make big money by betting on the financial troubles on the other company, against which they are buying the CDS. So if a hedge fund, like I'll again give an example, a hedge fund believes a company will go bankrupt, so they can buy CDS contract, like the way I explained in the previous slide as well. So if the company situation worsens, the CDS prices goes up. It will go up automatically. It's very but obvious. It's very natural. because now the probability of default is very high. So the CDS seller, the insurance seller, will charge high prices for CDS contract. That's why the CDS prices of the CDS contract will rise, and by selling them, the hedge fund can make profit. So this is exactly how hedge funds made billions actually, even during the 2008 crisis, because during 2008 crisis, the prices of the CDS soared very high, actually very high, because the probability of default of the financial institution, probability of default of the borrowers actually was very high at that time. If the probability of the default of the borrowers is very high, so that will push the prices of the CDS very high, right? And at that time in 2008 as well, that was happened. The prices of the CDS soared very high, and the hedge fund already bought the CDS at very low prices. And when in the 2008 crisis the CDS prices went up, then hedge fund sold all the CDS in the secondary market and booked a very huge profit. So that's the way they made billions actually, even during the 2008 crisis. Although a lot of companies went bankrupt, but still some of the hedge fund made a lot, billions of dollars with the help of speculation of the CDS. So that's the way. Fourth point, I didn't mention here the fourth point, but I'll try to explain. The CDS contract actually also helps to the price discovery. Actually, it also helps for the purpose of price discovery. Fourth benefit is the price discovery, right? Mainly, it means reveals market sentiment. CDS is very much helpful to reveal the market sentiment, because CDS prices reflect how much investor think a company, the borrower, is at risk of default. Like the way already I explained you that, yeah, in case if there's a high probability of the default, the prices will go up, right? So the higher the CDS cost, the greater the perceived risk. So that's the way it helps to reveal the market sentiment. CDS will help to reveal the market sentiment, right? So CDS in that way helps investor and policymaker understand the even credit risk in the real time. So these are some of the benefits CDS actually provide. But there are some of the risks as well, like the way I explained some of the case with 2008 crisis, even Greek debt crisis in between of 2010 and 2012. So because of that reason, there are some risks as well. So you can here see some of the risk on the screen. Overuse can lead to financial instability. CDS market can be highly speculative. If sellers like AG can't pay, it leads to a crisis, and that actually happened in 2008. So if CDS sellers like banks, insurance take on too much risk and fail to pay, it can cause a massive financial collapse, just like in 2008, right? So AIG sold billions in CDS but didn't have enough backup funds, reserves, right? And when defaults happened, AIG couldn't pay, and the entire financial system was at risk. And because of that reason, the US government had to bail them out with $182 billion US dollars. So this is how a small financial product can create huge problems if it is being mismanaged. So that's what one of the risk, right? Overuse, right? Overuse, or maybe sellers, without any check on the CDS, just selling the CDS contract. Also, CDS contract can create a false sense of security some of the times. It's a moral hazard. Why? Because it making investor take on more risk than they should. So, for example, banks gave out risky subprime mortgages before 2008 because they thought CDS would eventually protect them in case some default happened in the future. But when thing collapsed, systemic risk happened, domino effect implemented, domino effect got into the financial market, then CDS couldn't cover all the losses. So that's the way it encourages excessive risk taking, which actually creates a lot of moral hazard, will actually create a systemic risk in the market. So just because you have insurance, you have CDS contract, doesn't mean you should drive recklessly. That's the meaning of the excessive risk taking. Another risk about CDS contract is high speculation. So CDS is often used by the hedge funds. I told you that hedge funds and trader not to protect instrument, not to protect the investment, not to protect the default probability against loans lend to other companies, but to make money from failing companies. So for example, a hedge fund, let's say, buy CDS on a company, and they believe that that company will fail. So if enough people do this, then CDS prices rise because the demand will rise. That's why the CDS prices will rise. and making the company look weaker than it actually is. Although company is very stable, but people just trying to buy more and more CDSs, and CDS price because of the high demand will rise, and but that will create a very and that will show a very bleak picture of the company. Although company is very stable, so sometimes because of that reason, it pushes the company into bankruptcy, right? Because that will create a very bad image in the market, and eventually they will go bankrupt because they will not be able to operate, because they will not be able to get those level of business from the market. So this is why CDS is controversial sometimes. It actually hurts companies rather than just protecting investor. So these are some of the risks that I try to explain you. All right, now let's summarize and final takeaways what we have learned today. So CDS is like insurance for loans and bonds. Investor use it for protection and some of the time speculation profit as well, arbitrage trading too. Misuse of the CDS played a major role in the 2008 crisis, like I explained, how a US government had to involve and bailed out the AIG. And it's a powerful tool, but it must be used responsibly. Otherwise, it will create a very big trouble in the market, right? So, are credit default swaps good or bad? Well, the answer is it depends how you are using it, how they are being used in the market. If it used responsibly, they will help. They will help to manage the risk. But in case if it is being used recklessly, then they can create the financial disaster like 2008 crisis. So the key is regulation and responsible investing. So that's why we should use CDS, but responsibly, right? So if you found this video valuable, please hit like, share it with your friends, and subscribe for more finance insight, because I'll keep coming to you with more insightful videos, with more insightful concept in the world of finance for you, so that you can gain more knowledge. So thank you so much for being with me.